Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about what assets you should and should not own through your retirement accounts. So we all know that we can use retirement accounts as a great way to build wealth while minimizing some of the taxes that we'll have to pay on that money or those assets in those accounts. But it is critical that you understand how to best use your retirement accounts. I hear all the time people putting assets in a retirement account that doesn't make any sense. I also hear a lot of situations where people are not utilizing retirement accounts for certain types of investments that could really help them increase the ultimate returns or build more net worth because they minimize the taxes that they're paying. So it's really important that you understand how to properly use retirement accounts and what assets should or should not be owned through those accounts. Before I start, I do want to point out that I get people reaching out to me every day about, can they work with me? Will I advise on their specific tax situation or investment situation? I do not do client work. I no longer do any consulting. I sold, my consulting business several years ago. So if you are interested in learning more about the concepts that I talk about, I'll link below to a couple of courses that I have. There are courses that dive into some of my favorite investment strategies, and I also have courses that are really great for any business owners or investors who want to understand the best tax planning strategies that you can use. So check out that link below, but unfortunately, I do not work with clients anymore at this point in my career. So let's go ahead and dive right in. And I want to start by talking about how we should think about using our retirement accounts conceptually. So whether it's a 401k or IRA or a Roth 401k or Roth IRA, these concepts really apply to any type of retirement account that you have. So when I think about the types of assets that I want to put inside a retirement account, there's really three characteristics that I usually think about. So the three characteristics that I think about for good assets to put in retirement accounts are, number one, assets that I think are going to significantly increase in value. So here I think about things like cryptocurrency. I think about things like pre-IPO companies, except for certain types of companies that I'll talk about when we get to the next slide and talk about the 6 assets you should never put in a retirement account. I'll explain that more. But pre-IPO companies, where you're thinking about like the Peter Thiel Roth IRA strategy. If you don't know what that is, Google that. I have a great video out there on that. Those are the types of assets I think are great for retirement accounts because they're going to explode in value. When I think about like cryptocurrency, the types that I owned, my expectation is when I look 10, 20, 30 years down the line in the future, the value increases in those crypto that I owned will be significant. And if I didn't own it through a retirement account, I'd have to pay a significant amount of tax on that gain. So good assets for retirement accounts are ones that you think are going to significantly appreciate in value. Second are assets that kick off income that's subject to high rates of taxes. So that can be really any asset that kicks off tax inefficient income. So here I think about things like collectibles that are taxed at high rates. I think about stocks, dividend income. I'm going to talk a little bit more about myths around, taxes and tax planning, but dividend income is not tax efficient. Capital gains income is not tax efficient. So anything that's going to kick off income that's subject to high rates of taxes are good, assets to put inside a retirement account. The third point I want to, this is really important. I'll talk a little bit more about this when I go through some of the specific assets that you should not put in retirement accounts. But if there is no good tax planning available, and when I say tax planning, I mean tax planning that's really going to reduce, the taxes that you pay on whether it's the income that asset kicks off while you own it or appreciation in the asset, the gains that you're going to have, from holding that asset for a long time. If there's no good tax opportunities available, to reduce the taxes you'll pay on that makes that asset a good asset to put inside a retirement account. So the best assets are really the ones that combine all three of these characteristics. I personally do not own, any assets in my retirement accounts that don't have these three characteristics. So, think about, again, things like cryptocurrency, if you're a fan of crypto, things like certain pre-IPO companies, or, if you're starting a new startup or work at a startup in some cases, there could be some pieces, not the whole, you don't ever want to put all of those shares into a retirement account, but you might want to put some of those in there. Collectibles, hedge funds, hedge funds are very tax inefficient with the income that they kick off. And some of your stocks should also probably be in a retirement account if you're a big fan of the stock market. So with that said, I also want to point out that I talk a lot about this. The preferred retirement account for anyone who understands good tax planning is the Roth IRA. So historically, and if you're still working with a CPA who's maybe a little bit a fan of the kind of more antiquated views of tax planning, or if you have a financial advisor, they're probably telling you to max out your 401k or IRA. But if you've watched any of my videos, I hate those accounts. I prefer a Roth IRA. With that said, this video does apply to traditional 401ks and IRAs. It's not just applicable to Roths, but if you really want to use retirement accounts to the max, potential of them, you want to be looking at those Roth IRA strategies. And I have a lot of videos that talk about why I don't like 401ks and IRAs and why I prefer Roth. So check those out if you're interested. Also, before I move on to the specific assets you never want to own through a retirement account, I want to talk a little bit about a few tax myths in this space. So it's important you understand this because there's a lot of misconceptions out there. A lot of this is perpetuated by financial advisors and kind of old school CPAs, but there's a few things you need to understand if you're really going to dive into real tax planning that, really sophisticated, investors use in order to make a ton of money and not pay a lot of tax on that. So one thing to point out is that you do not at any point of your life want most of your savings inside a retirement account. I see this mistake done by a lot of really smart younger people who save early. They might, do something like have, a savings account that they then use as a down payment on a home, and then, defer, max out contributions to their 401k or something if they're a W-2 employee. So you never want a situation in your life where the vast majority of your savings are inside a retirement account. It's a really bad situation if you've got, most of your assets are a 401k and maybe a house that you own and equity in that home. That's just a really, really terrible balance sheet. Also, you don't want to get to the point where you're 65 or, getting to your retirement age and the bulk of your savings is inside a retirement account. There's a number of reasons of why that's a bad idea, but especially if you're using something like a traditional 401k or IRA that's not a Roth, then you absolutely never want a situation where the vast majority of your net worth is tied up inside those accounts. Also, this is a big misconception out there is that, and they, I'm a tax attorney and I was taught that, they train you to think that good tax planning is changing the rate from ordinary income rates, which are the highest, to capital gains rates. That is not true. Capital gains rates are still very high. I do not want to pay capital gains tax. So just at the federal level, you're talking about 20% federal tax plus the 3.8% Obamacare tax. Then you add on top of that state taxes. So a 24% rate of tax plus state tax, that is an absolutely terrible rate of tax. If you're paying a lot of capital gains tax, that's going to really eat into your ultimate long-term potential of, your total net worth. That is a huge chunk out of your savings or your earnings that you have. So don't be under the misconception that capital gains rates is a great rate to pay. That is not. You do not want to pay capital gains tax. Yes, it's better than ordinary income rates, but it's still a terrible amount of tax to pay. Also, watch out for certain, incentives of CPAs or, whoever, attorneys, whoever's advising you on this, that they may incentivize you to put certain types of assets in their 401ks. So if that person or individual or company does 401k administration or IRA administration, you need to be very careful about listening to them because they're incentivized in some cases to tell you to put more and more of your assets or net worth or money, whatever it is, into that account because that increases their fees. So I see a lot of influencers out there, on YouTube or podcast or whatever that'll say, put XYZ asset into your retirement account. That makes absolutely no sense from a tax standpoint. And then I go on their website and I see they do 401k setup and administration. So that explains to me why they're doing that. So be very careful of that. There's definitely some incentives they have to recommend things that might not be in your best interest there. So now that we understand how to think about retirement accounts conceptually, I just want to run through really quickly 6 assets that you should absolutely never own through a retirement account. So there's a number of different reasons, and I'll talk to you about why each of these assets are things that you should not own through your retirement account. But you need to be very careful because I see people make the mistake of putting these types of assets in the retirement account, and it can create an absolute tax nightmare. It can also create an investment nightmare, and it can really significantly reduce the amount of long-term, return potential you have on these investments for a number of reasons. It can also reduce flexibility in planning and doing other things. So these are 6 assets that I don't care if your CPA is telling you to do it, your financial advisor is telling you to do it. These are 6 assets that anyone who really understands sophisticated tax planning is going to tell you never own through a retirement account. So just really quickly, number 1 is real estate. If there's a CPA or anyone out there telling you to put real estate in a retirement account, you should absolutely run the other way. Real estate is the best tax investment that you can make. It is the most tax efficient type of investment you can make. The tax benefits of investing in real estate are absolutely wonderful, not only to minimize the tax you pay on the real estate investment itself, that direct investment, but it can also be used to reduce taxes you pay on other investments. So do not, under any circumstances, own real estate through a retirement account. That is a very, very bad idea. Yes, I hear certain influencers that are CPAs or tax attorneys advise that, but check it out. A lot of them do 401k administration, so they're incentivized to tell you to do that. I'm not going to dive into that in any more detail because I think it's pretty well known that you shouldn't own real estate through retirement accounts, but I want to be absolutely clear that that is a really big mistake to ever do that. So be careful with that. And if you have investments of real estate through retirement accounts, certainly going forward, don't do it again. 2 and 3 kind of go hand in hand. So this is getting a little bit more into the more complicated sections of tax planning, but any investment you have that is eligible for the 1202 qualified small business stock exclusion, that can be certain investments like VC or angel investment. So if you're investing through a venture capital fund, I like to do a lot of pre-IPO investing, and I like to do that mostly through venture capital funds because there's a lot of diversification and a lot of risk there that's minimized that way. But any investments you're making that are really early stage investments in a company. So if you're, venture capital, if you're that angel investor coming in early, number 3, if you're a founder of a startup, if you're an employee at startup and you're getting in there early, you have to understand this tax planning opportunity, 1202 qualified small business stock exclusion. If you don't know that, you need to understand that if you do any of these types of investments. So if you're a founder of a startup, an employee at a startup, if you're a venture capital investor, whatever, if you're getting in there pre-IPO early, you need to understand that tax planning opportunity. It can help you avoid up to $10 million in gain in some cases. If you're a founder of a company and you do a partnership flip structure, it can help you avoid up to $500 million in gains on your shares ultimately. So these are tax planning opportunities that you need to understand. So I put these types of investments into retirement accounts unless or except up to the amount that would be eligible for this exclusion. So if you are investing in a pre-IPO company, so say you went out and you got early into Airbnb before it was, just really early before it exploded in value. And so you can exempt up to 10 million of those shares of the gain under the 1202 qualified small business stock exclusion. That I am not putting into a retirement account because those shares or that gain can ultimately be excluded. If I'm a startup of Airbnb, if I'm the founder of Airbnb, I might put and do the Peter Thiel Roth IRA strategy for a good portion of my shares, but I'm not doing it for the amount that's excluded under 1202. So this goes back to what I was saying before, where if you've got an investment that has good tax planning opportunities, and that is the case with venture capital or pre-IPO with the 1202 qualified small business stock exclusion, you never ever want to own that for a retirement account because you just lost the potential to do that tax planning. So I know this is getting more sophisticated for a lot of you who don't dabble in these types of investments. But if you are a venture capital investment, if you're a founder, if you're a startup employee, you have got to understand this exclusion. You've got to make sure you're not owning too much or all of your investments through a retirement account. The fourth one asset that you never want to own through a retirement account is most businesses. So if you're an active business owner, if you own a business and you're actively involved in that business, you are most likely not going to want to own that business through a retirement account. The one exception I will say to that is if you're doing if your business is really a startup and it's a C corporation and you're doing the Peter Thiel Roth IRA strategy, then you're going to maybe put that into a Roth IRA. If you don't know what the Peter Thiel Roth IRA strategy, Google that, look for that video on my channel. That's very important to know that if you're someone who's a startup founder or employee or someone who does a lot of venture capital investing. Businesses, active businesses, most of your businesses are going to be S corporations. You do not want to own those through a retirement account. A lot of people buy businesses through doing something what's called a Rob's 401k. That's the absolute last way you should ever try to buy a business. I've never seen someone do that and it not be an absolute tax disaster in the long run. So, you want to avoid that. You don't want to put active businesses in your retirement account, and you certainly don't want to, own them through your retirement account or finance the acquisition by a way that's going to make them end up in your retirement account at the end of the day, unless you were doing that Peter Thiel Roth IRA strategy. So that's another one. A big misconception out there is I don't see this as much as, people who make the mistakes of putting real estate in retirement accounts, but, you never want to own a business through a retirement account if you can avoid it. The fifth one is stocks that you use for an SB-lock strategy. So this goes back to the point I was making before that you never want all of your savings or investments in a retirement account. you want some assets outside of that because you want some flexibility to do certain types of, more sophisticated investment strategies. And one of those is an SBLOC, where you borrow against your shares of stock to make other investments in secondary types of investments. And you're basically double investing the same amount of money, or you're just able to access the appreciation in those shares of stock without paying tax or triggering a gain. This is a strategy used by the wealthiest people out there, from Jeff Bezos, Elon Musk, to billionaires you read about that are able to become billionaires without paying any tax. Essentially what they're doing is an SBLOC strategy or a variation of that. So you want to make sure you don't have 100% of your stocks inside a retirement account, because you can't usually do SBLOCs if it's in an IRA or 401k. So you want them held through just a straight brokerage account if you're going to use those shares to do SBLOCs. So, and I personally like to do SBLOCs I do it on index funds. So I really only invest in index funds. And that's an S&P 500 index fund. I'm pretty vocal about the fact that, to me, that's the best way to invest in the stock market, in my opinion. Other large cap stocks that are, less volatile and less likely to just, go bankrupt or, lose a significant amount of their value. Those are good stocks that we usually like to think about doing an SBLOC strategy. So be careful with putting all of those types of stocks inside a retirement account, because then you can't do SBLOCs. The last one I want to point out, and this kind of goes piggybacks a little bit off of number 5 in the SBLOC strategy, is any assets that you're going to do the buy, borrow, die strategy for. So buy, borrow, die means you're going to buy an asset, you're going to hold it for a long time, usually best case scenario for your entire life, and then you're going to die still owning that asset, and your heirs are going to get that basis step up. I talk about buy, borrow, die a lot on other videos. You need to understand that if you don't. But if you're going to do that with an asset and you're going to use that strategy, then, you don't want to own that through a retirement account, because then you can't do buy, borrow, die in that case. So, if it's an asset, like for example, an S&P 500 index fund, I'm happy to own that for my entire life. I don't ever plan on selling those shares. My kids and my grandkids will inherit those shares when I die. Those are assets I use, for the buy, borrow, die strategy. So I definitely don't want those tied up in a retirement account. So yes, you might have some shares of stock inside a retirement account because it is a very tax inefficient investment, but you don't want all of them in there, especially if you're going to do SBLOCs and if you're going to do things like buy, borrow, die with those shares. So any assets that are ripe and able, to be used for buy, borrow, die, don't tie those up in a retirement account, because you're going to lose a lot of the benefits, or just you're going to lose the ability to do that great tax planning strategy. So this was a good overview of how you should think about what assets you should and should not own through a retirement account. And absolutely make sure that you never put any of these 6 assets inside your retirement account. Hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.